Yes, my dear students, warm greetings. Welcome to JK Shah classes RTP revision for Group 1 Accounting. Myself, Professor Gaurav, and I would be continuing with your RTP revision session. Now, in all, the recent RTP issued by our ICI has given 20 questions with respect to accounting subject. Let us start one by one. The first question is a very simple question pertaining to preparation of balance sheet and profit and loss account, that is financial statements, in accordance with Companies Act Schedule 3. So let us start, friends. From the following particulars furnished by Ambience Limited, prepare balance sheet on 31st March as required by Division 1 of Schedule 3 of Companies Act 2013. Equity share capital, obviously it's a balance sheet item. Calls in arrears, it will be reduced from equity share capital. Land and building, it will be shown under PPE, under share non-current assets. Plant and machinery, again PPE. Furniture is an item of PPE. General reserves will be shown under reserves and surplus. Loan from State Financial Corporation, nothing but long-term borrowings. Inventories of raw materials and finished goods. Can I say both of them will be part of my inventory in current assets? Provision for taxation. Let's see what is it. If nothing is there, then it will be nothing but short-term provisions. Trade receivables, nothing but trade receivables. Advances, short-term loans and advance. Profit and loss, that will be nothing but reserves and surplus. Cash in and cash at bank, nothing but cash and cash equivalent. Unsecured loan, that will be nothing but long-term borrowings. And friends, the last, trade creditors. Can I say trade creditors will be your trade payables. So this is what posting will be all about. Just have a glance. Just look at your balance sheet pertaining items. Now comes your adjustment. Let us look at our adjustment. 5,000 equity shares were issued for consideration other than cash. Can I say this is not an adjustment, friends? This will be disclosure in our notes to account. Which notes to account? Nothing but the notes to accounts, that is share capital, wherein we will write down of the above 5,000 shares have been issued for consideration other than cash. Then second point, trade receivables are rupees 130,000 are due for more than 6 months. Again, this is not an adjustment but an information pertaining to trade receivables. Now what are we going to do with respect to this trade receivable? Friends, what we will do is nothing but this 5 lakhs trade receivable will be shown as a bifurcation, more than 6 months, less than 6 months. The third point, the cost of the assets were building 15 lakh, plant and machinery 1750, and furniture 1,56,250. What does it indicate? It indicates that in our trial balance, they have given us all these 3 items, that is building, plant and machinery at WDV. This is nothing but the WDV amount. So this is WDV and this is original cost. This amount is original cost. So can I say, my friends, if this is the original cost, then the difference between the original cost and the WDV is nothing but very good opening balance for provision for depreciation. So when you make that note, original cost plus additions minus deductions, closing balance, then you write down provision for depreciation, opening balance plus additions minus deductions and closing balance. Don't you think the difference between this amount and the value given in our trial balance will be nothing but our opening balance of provision for depreciation? Now next, the balance of 375,000 in loan account with State Finance Corporation is inclusive of 18,750 interest accrued but not due. Okay, so we need to give a bifurcation, that is interest accrued but not due. This loan 3,75,000. So can I say the remaining amount will be long-term loan, and interest which is accrued but not due will be shown as our other current liabilities. The loan is secured by hypothecation of plant and machinery. So when we write down secured loan, there we will write in note, in bracket, in the particulars part, secured against hypothecation to plant and machinery. Balance in bank includes 5,000 with global bank, which is not a scheduled bank. Don't you think again this is a disclosure? This bank balance, we will just disclose it. Balance with scheduled bank, balance with non-scheduled bank. So out of 6,17,500, 5,000 will be shown balance with other than scheduled banks. Billed receivable 160,000 maturing on 15 June 2023 has been discounted. Friends, no adjustment has to be done because bill is already discounted. But don't you think the same has to be disclosed as contingent liability, possible obligation that the bill might get dishonor? So a possible obligation, so we'll show this as a contingent liability. Provide for doubtful debts 5% on trade receivable. So whatever are your trade receivable, on that we will create a provision of 5% and the corresponding effect will be there as a reduction from my profit and loss. Here friends, we have our solution. See. Very simple. Equity share capital 225 lakhs less calls in arrears. Reserves and surplus, in which we have general reserve, profit and loss, and this provision for bad and doubtful debt 25,000, which the question had said 5% on your trade receivables. So 5 lakh into 5%, which was 25,000. Long-term borrowings, secured loan, secured under hypothecation of plant and machinery, 375 minus 18,750, because 18,750 will not form part of my long-term borrowings, and this was unsecured loan. Other current liabilities, interest accrued but not due, that is 18,750. Short-term provision, that is provision for tax, and we have been given property, plant, equipment, accumulated depreciation, original cost, accumulated depreciation, original cost, and so on. I think friends, this was very simple question as far as final accounts was concerned. Again, the bifurcation with scheduled bank, with others, and cash in hand. And then we are supposed to make the balance sheet. And yes, this is what I said, contingent liabilities to the extent not provided for, bill discounted but not mature, 160,000. This is what we had. Yeah, we need to make notes for majority of all the items. You cannot write it directly. Like long-term borrowings, you might be thinking, sir, can I write down directly amount? Sir, trade payables, can I write it down directly? No, friends, you cannot. In majority of the case, bifurcation or certain notes are there, then it is always advisable to prepare a working note, in the sense notes to accounts. This was my question number 1. Let us move on to question number 2. That is pertaining to cash flow statement, which is AS 3. The question says, let us read it. On the basis of following information, prepare a cash flow statement for the year ended on 31st March 2023 using direct method. Total sales for the year were 796 crores, out of which cash sales amount to 524 crores. Received from credit customers during the year totals 268 crores. Purchase for the years amounts to 440 crores, out of which credit purchase is 80%. Balance in creditors as on 1st April 22, 168 crores. 31st March 23, 184 crores. Suppliers of other consumables and services were paid 38 crore in cash. Employees of the enterprise were paid 40 crores in cash. Fully paid 9% preference shares of face value 64 crores were redeemed. Equity shares of face value of 40 crores were allotted as fully paid up at a premium of 20%. 10% debentures of rupees 40 crores at a premium of 10% were redeemed. Debenture holders were issued equity shares in lieu of their debentures. 52 crores were paid by way of income tax. A new machinery costing 50 crores was purchased in part exchange of an old machinery. The book value of the old machinery is 26 crores. Through negotiation, the vendor agreed to take over old machinery at a higher value of 30 crores. The balance was paid in cash to the vendor. Investment costing 36 crores were sold at a loss of 4 crores. Dividends totaling 30 crores were also paid. Debenture interest amounting to 4 crore was paid. Non-cash expenditure incurred during the current year was 1.2 crores. Dividend declared during the current year was 15% on equity capital, which is nothing but 120 crores into 15%. On 31st March, the balance with bank and cash on hand total 4 crores. Okay, friends. This question is not complex, but many detailing stuff is given. Now, when we prepare cash flow statement, there were two methods, direct method, indirect method. Logically, this direct and indirect is applicable for operating activity only. Because investing and financing activity is always direct method only. So the focus of direct and indirect is with respect to operating activities. Now let us understand whether it is inflow, outflow, and it is pertaining to which activity. Sales of 796 crores, out of which cash sales is 524 crores. Can I say operating activity? 524 crores. Received from credit customer 268. Again, this will be shown as operating activity. Purchases amount to 440 crores, out of which credit purchase is 80%. It means how much is cash purchase, friends? 440 into 20%, which is nothing but 88 crores, will be operating activity. And they have given us balance of creditors. So what we can do is, this balance of creditors, we can prepare a creditor account. In which the opening balance is there. What will be our opening balance? 1422, 168. We have closing balance. What is the closing balance? 184 crore. And there are some purchases. How much purchases, friends? Can I say out of 440 crore, 80% is credit purchase, which means 350 crore is credit purchase. So here we will get a balancing figure. What is my balancing figure? That is nothing but cash and bank. So 168 plus 352 minus 184, which gives me 336. So that will be nothing but amount paid to creditors, 336, which has to be shown under operating activities. This again, suppliers of other consumables and services were paid 38 crores in cash. Can I say, friends, this is again operating activity. Employees of the enterprise were paid 40 crores in cash. Again, this is an example of operating activities paid to employees. Now comes next area. Fully paid 9% preference shares of the face value 64 crore were redeemed. Equity shares of face value of 40 crores were fully allotted as fully paid up at a premium of 20%. Okay, so we are issuing 40 crores equity shares at a premium of 20%. So it means 48 crore. So remaining amount, we are redeeming 64. The preference shares that is getting redeemed is 64 crores. We are issuing equity shares of 48. It means remaining amount of 16 crore is nothing but my financing activity, payments made. 10% debentures of 40 crores at a premium of 10% of redeem. So it means we have paid debenture holders 44 crore. And these were issued as equity shares. It means there is no cash inflow or outflow. This can be presented as a note. It will not appear in our cash flow statement. 52 crores were paid by income tax. Can I say again operating activity? Friends, before I go for other part, let me just verify our answers so that you can also simultaneously verify. You will be having your RTP with yourself, so things becomes easier. Okay. Now see, cash sales, which was 524, Then cash collected from customers, which was 268. Now purchases, can I say 336 was nothing but our operating activity, that is plus 440 into 20%, which was 88 also, that was also operating activity. This has been given as together only, working note only. So in cash paid to supplier was 336. Look here, this is what we had found out by preparing supplier's account. 336. So 336 plus what you have paid, 440 crores into 20%, which is nothing but 88, plus we have also paid for creditors for consumables 38 crore, and again payments to employees 40 crores. Together we are doing, so friends, 336 plus 88 plus 38 plus 40 gives me 502 is my cash outflow. This is what it is getting represented here. 502. Done? Okay. Thereafterwards, we have redeemed our preference shares and we have issued equity shares. So don't you think net of has been done? 64 and 48. This is what I had told you. 64 minus 48, which was nothing but 16. So I presented it here 16, 64 and 48, 16. Then friends, what was the next point we had? This was done. Debentures. What should happen with respect to debentures? Can I say debentures, there is no inflow and outflow. So we need to just give a note in the exam that the debentures have been redeemed. And your note is not given. You can just give an extra note that debentures have been redeemed and equity shares have been issued. ₹52 crores was paid as income tax operating activity. So here you have it, income tax, and then we get our net operating cash flows. Now new machine costing rupees 50 crores was purchased in part exchange of old machinery. The book value of the old machinery was 26 crore. Through negotiation, the vendor agreed to take over the old machinery at higher value of 30 crores. The balance was paid in cash to vendor. So how much did you pay to the vendor? Now if you look properly, your old machinery is 26 crore. The new machinery cost is 50 crores. Old machinery book value is 26, but it is now considered at 30 crore. It means, let us pass our journal entry, friends. The journal entry goes in this way. New machinery, account debit, it's 50 to old machinery. The old machinery is appearing in the books at 26 crore. So I will credit it by 26 crore. But don't you think the remaining amount I have to pay? Because this person will say, sir, you are buying something from us for 50. The value of what you are giving is 30. So you have to need to pay cash of 20. So I'll say, okay, I'll pay a cash of 20 lakhs. And can I say there will be nothing but profit on sale? How much will be the profit on sale? Nothing but 4 rupees. Balancing figure. Are simple, my dear. Don't you think your old machinery book value is 20, selling price is 30, 4 rupees? Okay. So in books, what will be shown? Cash will be shown of 20 only. You have paid cash of 20, investing activity. Yeah. So here, net payment for purchase of machine 20. Let's proceed. Investment costing rupees 36 were sold at a loss of 4. So can I say we have sold it for 32? Proceeds 32. Thereafterwards, dividend totaling 30 crores were paid. Dividend totaling 30 crores were paid. So that is an adjustment 120 crore into 15%. Dividends are declared. So that is just a declaration. Payment is not made. Here point number 9. But actually you have paid dividends of 30, which may be pertaining to previous year. So dividend paid 30. Done. Then debenture interest amounts to 4 crore is paid. So debenture interest paid. Non-cash expenditure, sir, it will not be presented in our cash flow statement. Same way, dividends declared, it is just declared. So accounting entry would be there. Profit and loss means in the sense retained earning, the reserves and surplus will be debited, and 2, proposed dividend, that will be there. But there is no cash outflow. So here friends, opening balance 200, then opening balance, we have closing balance. Done. So this is all about your cash flow statement. Very simple question. Just a small point that we had a machinery and this creditors point. So this is the end of your question number 2. Let me move on to the next question, that is question number 3. It is with respect to profits prior to incorporation. The partners of Shanti Enterprise decide to convert the partnership firm into private limited company, Shaurya Private Limited, with effect from 1st January 2022. However, the company could be incorporated only on 1st June 2022. The business continued on behalf of the company and the consideration of 3 lakhs was settled on the day along with interest at 12% per annum. The company availed a loan of 4,50,000 at 10% per annum on 1st June 2002 to pay consideration and for working capital. The company closed its accounts for the first time on 31st March 23 and presents you the following summarized P&L. Sales, cost of goods sold, discount to dealers, directors' remuneration, salaries, rent, interest, depreciation, office expenses, sales promotion expenses, preliminary expenses to be written off in the first year itself. Profit has been given. Sales from June 2022 to December 2022 were 2.5 times the average sales, which further increased to 3.5 times in January to March 23. The company recruited additional force to expand the business. The salaries from July 2022 doubled. The company also acquired additional showroom at a monthly rent of 5,000 from July 2022. You are required to prepare profit and loss account showing apportionment of cost and revenue between pre-incorporation and post-incorporation periods. Now, let us start, friends. I hope you would have read the question. Very simple question, not any complexity. First of all, we have to calculate time ratio. What is your time ratio? So, friends, my year starts, if you look properly, the period is starting from January. The partners decided to convert from 1st Jan 22. So, can I say 1st Jan 2022? This is what my period starts. And from 1st Jan 22, if you look properly, it is going till 31st March 2023. Now, when did we incorporate? Company was incorporated on 1st June. So, from 1st Jan, so Jan, Feb, March, 3 months. No, friends, it is not, I'm sorry for it. 1st Jan to 1st June, it means 5 months. Five months, Jan till May, that will be 5 months. And thereafterwards, June till March. That will be nothing but 10 months. So, our time ratio is 5:10, or you can say 1:2. That is time ratio. Now comes sales ratio. sales ratio. Now what does the question say? Read about sales ratio, friends. These are the two important things. Sales from June to December what 2022 were 2.5 times the average sales, which further increased to 3.5 times during January to March quarter. It means if I look at my pre-period, let me do it here, sales ratio pre-period and sales in post-period. In pre-periods, that is January, February, March, April, May, it is average. Let the average sales be X. So here it will be 5X because 5 months are there in pre-period. And what is happening in post-period? This is nothing but 5X is nothing but Jan to May. But the information says that from June to December, so June, July, August, September, October, November, December. So it is nothing but from June to December. What is happening, friends? From June to December, it is 2.5 times the X. Nothing but 17.5x. And then Jan to March, the next period, it is becoming how much? It is becoming 3.5 times. So 3.5 into x into 3 months, which gives me 10.5x. So this comes to 28x. So my sales ratio is 5:28. I got two things. My time ratio 1:2. My sales ratio 5:28. Now let's move on with respect to each and every item. Sales will be in sales ratio. Cost of goods sold also in sales ratio. Discount to dealers will be in sales ratio. Directors' remuneration will be nothing but post only. Salaries, of course, there is some adjustment to it. Some salaries they have talked about. So we have to look at the adjustment. There is some adjustment. As far as rent is concerned, rent is also some adjustment is there. For interest, now what should we do with respect to interest, friends? So the question says, you have taken up a loan. When did you take up a loan? So it is given in the beginning. The business was continued and the consideration of 3 lakhs was settled on the day along with interest of 12% per annum. The company availed a loan of 4,50,000 at 10% per annum from 1st June to pay the purchase consideration and for working capital. Okay, so interest also we have an adjustment area. Depreciation, obviously time ratio. Office expenses, time ratio, that is nothing but 52,500. 17,500 and the remaining amount. Sales promotion, sales ratio, preliminary expenses, it will be post. Now let me jump directly to my solution part. Sales ratio 5:28, done. Now for ratio for salaries, obviously that is 5:19. You'll say, sir, let us understand. See friends, the question says the company recruited additional workforce to expand the business. The salaries from July 2022 doubled. It doubled. What does it mean? For first 5 months it was X. Now it is 2X. And how many months are there? Don't you think? 10 months. July till 23. July 22. So June it is X. July till March. X into 9 months. So total 10 months are there in post period. Into 2, 18. So my ratio is 5:19. So that's simple point. Then comes your rent wala adjustment. Total rent is 67,500. You will say, from where did you get? Look here, this is rent adjustment, 67,500. Now additional rent. Why additional rent? Because we have taken the property from July, that is 5,000. So that additional rent is exclusively for post period only, na friends. So that is 5,000 for 9 months from July till March. So that I removed it because it is exclusively post. So it will go in post only. And the old premises rent, so that is how much? 22,500. This 22,500 will be divided in which ratio, sir? That will be in time ratio, 1:2. So 7,500 and 15,000. So this adjustment is also done. Now coming on to calculation of interest, pre-incorporation period interest from Jan 22 to May 22. That is nothing but you have to pay interest. On what amount you have to pay interest? If you look properly here, the question says you have to make payment of purchase consideration of 3 lakhs, and on that 3 lakh it was settled at 12% per annum. So you have purchased the business in January. So January, February, March, April, May, 5 months interest will be there. Nothing but 3 lakhs into 12% for 5 months, which gives me 15,000. So interest of 15,000 is for pre. Then comes the post period interest. Which is that post period interest? Sir, we have taken a loan of 4,50,000 on 1st of June only. So 4,50,000 into 10%. That is for how many months? Sir, that will be for 10 months. 37,500, 10 months. Done, friends? So this is all with respect to your adjustment. Look at the bifurcation. Sales, you have a gross profit. Obviously, it's a balancing figure. Cost of sale got divided in the ratio of sales ratio. Then discount, sales ratio, director remuneration, post, salaries, we did working note, rent, interest also working note. Depreciation will be in time ratio, office expense time ratio, preliminary expense post, sales promotion time, sales ratio, I'm sorry, my bad. The net profit, and this nothing but loss. Pre-incorporation period, there is a loss. Yeah, friends, so that is the end of our question number 3. Let us now move on to next question, that is question number 4. Oh, very simple question. Accounting for bonus issue. Following is the extract of balance sheet of Abhishek Limited as on 31st March 2023. 60,000, 12% preference shares of 10 each, 6 lakhs, 8 lakhs equity shares, 80 lakhs, that is your authorized, issued 48,000 preference shares, 5,40,000 equity shares of 10 each, 8 paid up, reserves and surplus, capital redemption reserve, security premium, general reserve, profit and loss account. On 1st April, the company has made a final call of rupees 2 each on 5,40,000 equity shares. The call money was received by 20th April. Thereafter, the company decided to capitalize the reserve by way of bonus at the rate of 1 share for every 4 share held. I don't think so any challenging stuff is there. You are making your shares fully paid up, which is very much prerequisite before you go for any bonus issue. All your shares should be fully paid up. So 5,40,000 into 2, we would have received that amount. Equity share final call to equity share capital, and then you received it. Now how much bonus shares you are giving, friends? So the question says you are giving 1 share for every 4 share held. So 5,40,000 divided by 4, you will be giving 1,35,000 shares as bonus into 10. So 13,50,000. From where would you finance this 13,50,000? What will be the debit? Can I say we will be using CRR? Thereafterwards, this security premium, then general reserve. So 1350 minus 240 of your capital redemption reserve minus 150 of your securities premium minus 7,20,000 of general reserve. Left out is 2,40,000 will be used from profit and loss account for the purpose of giving bonus. So this is your entry. I don't think so any big stuff is required. Yeah, the extract of the above, this many shares have been issued for consideration other than cash. That stuff we have to give it. Okay, friends. Let us now move on to another question. So journal entries and prepare rights. Right issue, that is question number 5. Beta Limited has decided to increase its existing share capital by making right issue to its existing shareholders. Beta Limited is offering 1 new share for every 2 shares held by the shareholder. The market value of the share is 180 and the company is offering one share at 90, calculate the value of right. What should be the X right price? You remember this, you would have done while doing your AS20 also, and also by doing company final accounts. Nothing but you had a formula, X right price fair value prior to right into existing shares plus exercise price into right shares, the whole divided by existing shares plus right shares. So if you look properly, the market value of your share is 180. Okay, and for every 2 you are giving 1. So 180 into 2 plus you are giving 1 right share for every 2 shares held. into 2 plus 90, that gives me 450 divided by 3. Nothing but 150 is the X right price. What is the value of right? Nothing but fair value prior to right minus X right price. 180 minus 150, which is nothing but 30. Okay, so question number 5 is also done, my friends. Now question number 6 is redemption of preference shares. The capital structure of Ambuja Limited consists of 40,000 equity shares of 10 each fully paid up and 2,000 8% redeemable preference shares of rupees 100 each fully paid up issued on 1st April 2018. Undistributed reserves and surplus stood as general reserve 160,000, profit and loss account 40,000, investment allowance reserve 20,000, of which 10,000 is not free for distribution as dividend. Cash at bank amounts to 1,96,000. Preference shares are to be redeemed at a premium of 10%. For the purpose of redemption, the directors are empowered to make a fresh issue of equity shares at par after utilizing the undistributed reserves and surplus, subject to a condition that a sum of 40,000 shall be retained in general reserve and which should not be utilized. Past journal entries to give effect to the above arrangement and also show how the relevant items will appear in the balance sheet of the company after redemption is carried out. Now friends, if you look properly, how we are going to take care of it. So there is nothing but my question number 6. Face value of preference shares to be redeemed. It is this will be, can I say, CRR out of divisible profits plus fresh issue. This is what we have to consider. And premium on redemption of preference shares. This will be through divisible profits. Now my dear students, if you look properly, question, your preference shares are 2,000 into 100. So 2,000 into 100, that is 2 lakh, and you are going to redeem it at 10% premium. So this is 2 lakhs. This is 20,000. So this 20,000 will be through divisible profits. What is the divisible profit available to us? Can I say the divisible profit which is available to us is P&L account, which is of 40,000. So I will use P&L account to that extent to write off my premium. Now for remaining, are we issuing some equity shares? Question says yes, you are empowered to make fresh issue of equity shares after utilizing the undistributed reserves and surplus. Subject to a condition, a sum of 40,000 will be retained, it will not be utilized. It means how much things can I utilize for divisible profit? Can I say investment allowance reserve I can utilize? How much of investment allowance reserve? Sir, investment allowance reserve, the balance is 20,000. I can utilize only 10,000. Then I can utilize general reserve. How much of general reserve I can utilize, friends? General reserve, if you look properly, the balance is 160, but we need to have a balance of 40, which means I can utilize only 1,20,000 of general reserve. And I also have profit and loss account. How much I can utilize? Sir, profit and loss account balance is 40,000, out of which 20,000 is already utilized. So what is left out is 20,000 only. So if you look properly, how much CRR I can create is nothing but 20,000 plus 120,000 plus 10,000, which is nothing but 150,000 CRR can be created max. Which means the balancing figure I require CRR plus fresh issue to be 2 lakh. My CRR is 150, so remaining will be fresh issue. 50,000 will be fresh issue. Okay, so friends, that is the solution here. This is the only important area what we had. So bank account debit to equity share capital 50,000 pertaining to this. This is FV is nothing but face value. Then 8% redeemable preferences 2 lakh, premium on redemption account debit 20 to preference shareholders, preference shareholder account debit to bank. Then you will write off the premium. And then we are creating CRR. General reserve 120. Look here. General reserve 120. Profit and loss 20,000. Because out of 40 we have already utilized investment allowance reserve. And this is what. Okay. So this the balance sheet. I hope you can do this on your own. Nothing big in this. Now friends, let's move on to the next question. Question number 7, redemption of debentures. The following balance appeared in the books of Lucky Limited on 1st April 2022. 10% debentures, 75 lakhs. Balance in DRR, 2,50,000. Okay, there is a shortfall. Let's see. DRR investment, 11,25,000. Represented by 10%. Rupees 11,250 secured bonds of the Government of India of 100 each. Annual contribution to DRR was made on 31st March every year. On 31st March 23, the balance at the bank was 7,50,000 before receipt of interest. Interest on debentures had already been paid. The investments were realized at par for redemption of debentures at a premium of 10% on the above date. Lucky Limited is an unlisted company other than all India financial institutions, banking company, non-banking financing company and housing finance company, HFC, NBFC and that AFI. You are required to prepare a debenture redemption reserve account, debenture redemption reserve investment account, bank account in the books of Lucky Limited. Okay, only this much. Very simple friends. Only one thing we need to have an idea that your balance in debenture redemption reserve has a shortfall. It should be 10%. That is 7,50,000 should be the balance. I have a balance of only 2,50,000. So what I need to do is create DRR. Here it is. Opening balance by balance brought down 2,50,000. There is a shortfall. How much shortfall? Sir, it should be 750. So we create a DRR, profit and loss account. Yeah. 10% of 75 lakh, 750, available balance this much, DR required is this much. And then rest everything. Your investments are adequate. There is no shortfall as far as investment is concerned. So you had an opening balance of investment 1125, you sold off at 1125 at par, but prior to selling it off, we received interest at the rate of 10%. So in our bank account, we got the interest, and then we are redeeming our debentures. So how much do we pay? So the question clearly says debentures are redeemed at, the investments were realized at par for redemption of debentures at a premium of 10% above. So 10% of 75 lakhs, 8250. And this is my closing balance. I don't think so this requires any more discussion, friends. A very simple question. Only point which was very, very important was I need to have a DRR of 10% of the face value. So friends, question number 7 is also over. Let's move on to question number 8. This is with respect to your investment accounting. On 1st April 2022, Alpha had 1 lakh equity shares of Beta Limited at a book value of 15 per share, nominal value 10. He provides you further information. It means it is my opening balance. I do it simultaneously because this is a simple chapter. To balance brought down, number of shares 1 lakh, 15 lakh is the amount for us. Next. This is nothing but our value at which we had purchased. On 20th June, he purchased another 20,000 shares at 16. So number of shares 20,000 and 20,000 into 16, that will be nothing but amount 3,20,000. This part. Okay. Again. Next area. On 1st August, Beta Limited issued 1 equity bonus for every 6 shares held. If you are holding 6, you are going to get 1. How many shares are you holding? Can I say you are holding 120,000 shares? So how many shares will you get? Obviously 20,000. So bonus 20,000 shares. No amount because no consideration is paid. The next. On 31st October, the directors of Beta Limited announced the right issue which entitles the subscriber to 3 shares for every 7 held. So now they say if you hold 7, we will be giving you 3 shares. How many shares do you hold? Don't you think you already had 120? Then you got 20 bonus. So you have 140 shares now. So 140 shares into 3 divided by 7, that gives you 60,000 right shares. And what did you do? You sold 1/3 and subscribed for the rest. At 15 rupees. So you paid how much? 6 lakhs. So 40,000. How did you get 40,000, friends? 60,000, 1/3 is sold, renounce. 2/3 is purchase. Okay, so that point is over. Now, this amount which is received on renouncement, what should I do? The amount received on renouncement in absence of all information should be credited to profit and loss account. Don't get confused if com right and x right and we should compare and this and that. No information is given. You just say the x right price is more than the com right price. So it will be credited to profit and loss account. Clear, my dear students? Okay. Let me move on to the next question. Question number 9. The premises of Animesh Limited, that is nothing but loss of profit, loss of stock chapter. Question number 9. Caught fire on 22nd Jan 2023 and the stock was damaged. The firm makes accounts up to 31st March every year. On 31st March 2022, the stock at cost was 1372 as against 9,62,000 on 31st March 2021. Purchases from 1st April to the date of fire was 34 82,700 as against 45,25 for the full year of 21-22 and corresponding sales figure 49,17 and 52 respectively. You are given the following further information. On July 22, goods costing 1 lakh were given away for advertising purpose. No entries have been made. During 22-23, a clerk had misappropriated unrecorded a cash sale. It is estimated that the defalcation averaged 2,000 per week from 1st April until the clerk was dismissed on 18th August 2022. The rate of GP is constant. The above information, calculate the stock on the date of fire. First, friends, what we should do, we should prepare memorandum trading account. From memorandum trading account, we will get gross profit. From that, we will get gross profit percentage. So for preparing memorandum trading account, can I say last year figures are required? That last year figures was 45,25 purchases, yeah, and the sales figures are 52 lakhs. So purchase and sales figures I have got. Opening and closing stock also they have given me. Yes, the 31st March 22, the stock at cost was 1327,200 and 962,200. That is nothing but my opening stock. So here you are. Opening stock, closing stock 1327,200. Purchases and sales 45,25 and 52. 45,25 and 52. I got my GP. GP ratio is 20%. Things are simple. Now what we can do? Nothing but we can find out what is nothing but the stock on the date of fire by preparing memorandum trading account. That is from 1st April 22 till the date of fire. So whatever is closing stock in my previous period, this will become opening stock. That is done. Thereafterwards, friends, what has happened? We have some purchases which is given here. If you look properly, purchases figure 34,82,700, sales figure 49,17. So 34,82, 49,17, and there are certain adjustments. 1 lakh was given away as advertisement, nothing but goods distributed as free samples. It will be shown on the credit side of trading account, or you just reduce it from your purchases, one in the same. Then the second adjustment is there, friends. The second adjustment is the clerk has misappropriated. Now, if he has misappropriated 2,000 per week, so how many weeks are there? Do it very simple way. First of all, April 30 days, May 31 days, June 30 days, July again 31 days, and he is caught on 18th of August, so 18 days. So in all, from 1st April till 18th August, there are 140 days. Divided by 7, so how many weeks? Nothing but 20 weeks. Each week is defalcating 2,000. So 2,000 into 20, which gives me 40,000 of cash sales have been done. So 40,000 cash sales will be added to my total sales. This is how it is. And now 49,57,000 into 20%, that is my profit. Closing stock is a balancing figure. 7,44,300. So simple, na? Yeah, friends, because in class, when you were doing all average and complex questions, challenging questions. So you'll be finding all these questions to be very, very easy. Now comes hire purchase. The following particulars relate to hire purchase transactions. X purchased 3 cars from hire purchase basis. The cash price of each car is 1 lakh. The hire purchaser charged depreciation at 20% on diminishing balance method. 2 cars were seized by the vendor when second installment was not paid at the end of the second year. The hire vendor valued the 2 cars at cash price less 30% depreciation charged under diminishing balance method. The hire vendor spent 5,000 repairs of cars and then sold them for a total amount of 85,000. You required to compute agreed value of 2 cars taken by hire vendor, book value of car left with hire purchaser, profit and loss to hire purchaser on 2 cars taken back by hire vendor, profit and loss on car repossessed when sold by hire vendor. So they are going on accounting in the books of the purchaser as well as vendor. Now friends, very simple. Agreed value of 2 cars taken by the hire vendor. Now if you look properly, the cash price is how much? 1 lakh. So 1 lakh into 2 lakhs. On that you will be depreciating it not 20% but 30%. So for 2 years, so it comes to 98,000. Here it is. Okay, agreed value 1 lakh. This. Now book value of the car. One car. What will be the book value? Sir, I would have charged depreciation as per 20% because for buyer the rate was 20% diminishing balance. Look here. Here? Okay. So in the books of buyer, 64,000. Third question. What is the third question? Profit and loss to the HP purchaser on 2 cars taken back by the hire vendor. Now what did the hire vendor do? Hire vendor has adjusted the value. Now what is the value which the hire purchase vendor is giving me? Sir, he is giving me only 98,000. That is the value of the asset he is adjusting. I purchased the asset for 2 lakhs. On 2 lakhs, I provided depreciation for first year 20%, second year also 20%. So the value of the asset in my books is 1,28,000. But I am getting only 98,000, which means there is a loss of 30,000. Here it is. Done? Thereafterwards, what is the profit and loss to the HP vendor person? Vendor has taken the car at what value? 98,000, and then he did some expenses of 5,000, and then he sold it for 85. So 98,000 plus 5,000, and he sold it for 85. So the vendor also makes a loss of 18,000. Here it is. Done. So friends, this is all about your hire purchase. Again, a simple question. Now let us move on to next question. Now my friends, departmental accounts. A firm has 2 departments, P and Q. Department Q makes furniture with the wood supplied by P department at its usual selling price. From the following figures, prepare departmental trading and profit and loss account for the year 2022. P and Q, opening stock on 1st Jan 2022, 3,50,000. Sales, purchases, supply to Q, selling expenses, wages, closing stock. The value of stock in furniture department consists of 75% wood and 25% other expenses. P department earned a GP of 15% on sales in 2021. General expense of the business came to 110,000. The firm adopts first in first out method for assigning cost to the inventories. Now my dear friends, don't you think this opening stock of the receiving department, that is Q department, will be including goods from P, but this opening stock we have to bifurcate that 75% is wood, 25% is other expense, and whatever is wood, on that there is a profit margin of 15% on sales. So that opening stock reserve we have to do. Rest everything is same. Same thing is with the closing stock. Again, closing stock I will bifurcate it. Something is received from the P department. So on that 60,000, 75%, that is the selling price. That has a profit of 15%. So that is nothing but stock reserve on closing stock and opening stock. So here it is. Opening stock 30,000, 3,50,000 just taken from here. Sales 24 and 4 done. Sales, opening stock. Next is purchases 20 and 15. Thereafterwards supply to Q Okay, so to transfer from P department and by transfer from Q department, because P is transferring it to Q. 3 lakhs. Selling expenses, wages and selling expenses. That. Now, of course, the question has also mentioned that there are general expense of 110,000 that goes in general. Now, how much opening stock reserve and how much closing stock reserve? So, opening stock of Q department is 50,000. On that, 75% bifurcation. So 50,000 into 75% is wood, and on that 15%, that is nothing but 5625. Same way, closing stock 60,000 into 75%. But now, can I do 15%? You'll say, why not, sir? No, my dear friends, look properly. This year, I'm getting the GP margin. What is my GP margin? 540. So 5,40,000 divided by 24 lakhs and 3 lakhs. So it is 26, 5, 20, 25, 26, 27. 5,40,000 divided by 27 lakhs, which gives me 20% is the margin. So on closing stock, I will not take 15% because 15% was the margin in the previous year in 21. So now we will be having a margin of 20%. So there is nothing but 20%, which is 9,000. Done. So closing stock reserve 9,000. Rest everything is simple. Only one point you had to remember, important point in this particular question of our RTP friends, that is stock reserve on opening stock will be based on GP percentage of previous year, whereas stock reserve on closing stock will be based on GP percentage of current year. Now, proceeding further, branch accounts. Trade mill invoices goods to its branch at cost plus 20%. The branch sells the goods for cash as well as on credit. The branch meets its expenses out of cash collected from its debtors and cash sales and remits the balance of cash to head office after withholding 20,000 necessary for meeting the immediate requirements of cash. On 31st March 2022, the assets of the branch were as follows. Branch assets, cash in hand, 20,000, trade debtors, stock at invoice price, furniture and fittings. During the accounting year ended on 31st March, the invoice price of the goods dispatched by the head office to the branch amounts to 2 crore 64 lakhs. Out of the goods received by 8, the branch sent back to the head office goods invoiced at 144,000. Other transactions at the branch, cash sales, credit sales, cash collected by branch, cash discount allowed to debtors, returns by customer direct to head office, bad debts written off, expenses paid by the branch. On 1st January 2023, the branch purchased the new furniture for 2 lakh, for which payment was made by head office through check. On 31st March 2023, branch expense amounts to 12,000 were outstanding and cash in hand was again 20,000. Furniture is subject to depreciation of 16% on diminishing balance method. Prepare branch account in the books of head office. Only one branch account where we will write all the assets and liabilities, opening balance, and then the transaction. We have to write it down. The transaction between the branch. Now, very simple stuff. This is the preliminary chapter, I can say. You would have remembered while doing your branch chapter. First question was this type of question only. So opening balance in my branch account, nothing but my capital balance, investment balance, which is 20, 768, 2160 and 1000. Opening balance. Thereafterwards, when you say stock, don't you think the stock is at invoice price? So it should be Loading element. How much is the loading element? So loading element, if you look properly, if you read the question, in the beginning it was given invoices at cost plus 20%. Cost plus 20, that is 1/5 on cost, 1/6 on sales. So friends, stock is 2160 divided by 1/6, that is 360, is nothing but here. So this is nothing but effect with respect to our opening part. Now thereafterwards, what is happening? Go one by one transaction. We are going to record only transactions between whom? We are going to record transaction only between the branch and the HO, and HO and the third parties which are done in relation to the branch. But the transaction between the branch and third parties will not be captured by us. Now friends, goods sent to branch, these all transactions will not be captured by us. We have sent them 2 crore 64 lakhs. So 26,400, nothing but rupees is in thousands. And on this, there will be a loading element. The loading element and goods written by HO also has been considered. And the net amount has been considered here. Net goods sent to branch 26,256 into 1/6. 26,400. Okay. So goods sent to branch 4376. Loading element. Thereafterwards, moving further, on 1st Jan, branch purchased new furniture 2 lakh, for which payment was made by the head office only. Now all these transactions, friends, will never get reflected in the books. You'll say, why sir it will not be reflected? Friends, very simple. This is a transaction between branch and the third party, never recorded. But the transaction between the branch and HO, always recorded. Transaction between HO and third party on behalf of the branch will also be recorded. That is nothing but 2 lakh. We have purchased the furniture. Here it is. Thereafterwards, what are we supposed to do? Sir, we got remittance. How did you come to know about remittance? For that, we have to make branch cash account and some other accounts also, which is nothing but this. Branch cash account, opening balance and closing balance has to be same. You sold, you received money, branch expenses 23,400 is nothing but the remittance made to the head office. So that amount we have written here. Done. Now closing balances. Closing balance of all assets and liabilities which are there at the branch. What are the closing balance of the assets and liabilities? Question here is already given. Cash will always be 20. Debtors, we have to find it out. So we had opening debtors. On that there will be sales, receipts, discount, bad debts, all that adjustment. Normally what you have been doing. Yeah. So debtors, opening, branch stock, branch cash, this balancing figure. Same way branch furniture also balancing figure, and branch stock also balancing figure. So this is what we get. These are all our closing balances. And then the question also talks about there is some outstanding expenses. 12,000 is outstanding. So branch liability is there and closing balance of my stock reserve. Okay friends, so very simple, nothing big in this. Let me proceed further for this. Okay, you may just look at the solution. Customers have directly returned to head office has not been made in branch stock account. but that would have been adjusted by us, huh? Goods sent to branch account, returns to HO and all those things, that has been adjusted here. See this, returns by customer directly to head office 204, and branches also written some goods of 1,44,000. Both of them have been considered here, and then the loading element has been considered. Okay friends, only one important, new furniture is purchased on 1st Jan, so 3 months depreciation is there. I don't think so. All other things are simple here. Let me move on to the next question, which is single entry. From the following information in respect of Mr. Raman, prepare trading and profit and loss account for the year ended on 31st March and balance sheet. Stock in trade, debtors, opening is given, closing is not available. Bill receivable, opening is nothing, closing is not available. Creditors for purchase, furniture are written down, expenses outstanding, prepaid expenses, cash on hand, bank's balance. Now all these accounts have to be prepared. We will prepare ledger accounts for each of these items, that is stock, debtors, bill receivable, creditors purchase, furniture and all those things. Then only we will get balancing figures. Collection from debtors. So your entry will be cash account debit, discount account debit to debtors. This is the amount collected. 2340 is 97.5. 2.5 you can find out. Payment to creditors after receiving. So this is payment made. Creditors account debit to bank 1568 to discount, that is P&L. Proceeds of bill receivable discounted, you have discounted at 2%. So bank account debit 245, discount account debit, that is 2%. Don't say 245 2%. 245 is after 2% discount, means 245 actually indicates 98%. So bank account debit, discount account debit to bill receivable. Proprietor's drawing, there is drawings, that is capital account to bank. Purchase of furniture, furniture to bank, and then we need to depreciate it for 6 months. Government securities purchase, government securities, that is investment account debit to bank 4 lakhs. Expenses, expenses to bank 7 lakhs. Miscellaneous income, bank to miscellaneous income. Sales are affected so as to realize a GP of 50% on cost. Sales are 50% on cost. 1/2 on cost, 1/3 on sales. Capital introduced during the year by the proprietor by check omitted to be recorded in cash book, though the bank balance of 3,000 on 31st March is after taking into account. Okay, capital introduced. So can I say my entry will be bank account debit to capital? Purchases and sales are only on credit. During the year 4 lakh bill was drawn. So beta, you will be passing a journal entry. Bill receivable account debit to debtors. Out of this 80,000 were endorsed in form of creditors. So creditors to bill receivable 80,000. Out of this, bill of 16,000 was dishonored. So your entry will be nothing but debtors to creditors 16,000. Okay. Now you may just first go through the question. I went a little bit of faster. I'll just wait for 2 minutes. You just go through the whole question. Pause the video. Go through the question. You will be having your own RTP available. Now friends, we'll just look at the figures from all our notes, because we have to prepare elaborative notes. Furniture account, nothing but opening balance, closing balance, we have purchased, the rest is nothing but depreciation. This is what we had. Furniture, if you look properly, here it was at written down value, opening and closing, and there is a purchase of 40,000, that is what I passed in entry. Okay, cash and bank, all these things. And if you look properly, after passing all these entries, there is a balancing figure which comes, that is nothing but additional capital brought. Now debtors account, opening balance of bill receivable was 0 only, closing balance was given. The that was question mark, and we have found out that question mark 70,000. Creditors also purchases balancing figure. We prepare opening balance sheet. Friends, I don't mind doing everything, but it will just take a lot of time because there is nothing new in this. Now, what is my sales? Cost of goods sold, opening plus purchase minus closing. Opening is 320, purchase is 1824. You said, how did you get this 1824? Friends, from my purchases account, I can get from my creditors account, because opening balance was given 440, closing balance was given. Look properly. Your creditors, opening and closing is given 440 and 6 lakhs. And then we have been given how much payments have been made to creditors after receiving this much discount. So in creditors account, we can write down bank and discount. Then a bill was endorsed. So creditors to bill receivable. Then that bill was dishonored also. So this amount. So this is balancing figure 1824. So opening stock plus purchases minus closing, that gives me COGS. And on that COGS, there is 1/2 profit on cost. 1864, 1/2. This gives me sales of 2796. Now this sales is totally credit sales, and that will be going in my debtors account. Okay, this question is simple, but friends, it only has lot of calculation. We need to go slowly, one by one, then only this sum can be done. Debtors account, this sales was there, and the remaining balancing figure comes here. Rest, nothing new in this question. Expenses, okay, you can just presentation, I would just make it this way. Expenses paid. What is the amount of expenses? 7 lakh. Now can I say whatever is outstanding of current year, that will be added, minus outstanding of previous year will be reduced. Whatever is prepaid of current year will be deducted, and what is prepaid of previous year will be added. So outstanding of current year 80,000 and 72,000. 80,000 is previous year, 72,000 is current year. Then we have prepaid also. Prepaid 24,000 is previous year, 28,000 is current year. $24,000 is previous year. No, sorry, I made an error. 24,000 is previous year. 24,000 is previous year. Okay, transpositional error. $24,000 and $28,000. Okay. Prepaid 24 will be added, in current year it will be subtracted. So it is 688. Done. So that was the simple stuff, not that much. Interest on government securities 24,000. It is accrued, so balance sheet asset side and P&L on the credit side. Interest on this. Okay friends, I hope you can just have a glance over the whole question. Okay, now let's move on to some other question. framework related question. X Limited has entered into a binding agreement with Alpha to buy a custom-made machine, 2 lakhs, at the end of 22-23. Before delivery of the machine, X had to change its method of production. The new method will not require machine order as it will be scrapped after delivery. The expected scrap value is nil. You are required to advise accounting treatment and give necessarily journal entry. Can I say the whole amount will be expensed off? Why? The reason is very simple. You should recognize an asset only if future economic benefits will flow to the entity. There is no future economic benefits which is going to flow to the entity. Hence, the whole expense of rupees 2 lakh will be charged to profit and loss account. It does not fulfill our asset recognition criteria only. Loss on change 2 lakh, profit and loss to loss means the whole P&L, that asset is not getting recognized only, but I still have to pay to Alpha 2 lakhs, so that 2 lakh is our liability. So 14th, then 15th. ABC was making provision for non-moving inventories based on issues of last 12 months up to 31st March. The company wants to provide based on technical evaluation. Does this amount to change in accounting policy? No. Can the company change the method of provision? Yes. This is not a change in accounting policy. What is accounting policy? Accounting policy refers to specific accounting principles and methods used to apply those principles. Whereas what is accounting estimates? Accounting estimates are approximation of certain amounts in absence of proper means of measurement. So don't you think, first of all, you were creating provision? Are you still creating provision? Yes, my accounting policy is to create provision against non-moving stocks. The stocks which I am not able to sell, they will become dead stock later on. I have to scrap it off. So I am creating provision for those non-moving stocks. Earlier also I was making provision. Now also I am making provision. So there is no change in the principle. We are still going for it. Earlier we were making provision considering how many goods have been issued. But now we are going to make provision based on some technical evaluation. So this is change in an accounting estimate and not change in an accounting policy. The decision to making non-provisions based on does not amount to change in accounting policy. Earlier we were making, so because of this 3.5 will be 2.5 is also not material. Disclosure can be made, not should be made for such change. Okay, so this is the disclosure that we can make. Question number 16, that is valuation of inventories. Alpha Limited sells flavored milk to customer. Some of the customer consume the milk in the shop run by Alpha Limited. While leaving the shop, the consumers leave the empty bottles in the shop and company takes possession of these empty bottles. The company has laid down a detailed internal record procedure for accounting for these empty bottles which are sold by the company by calling for tenders. Keeping in view, decide whether the inventory of empty bottle is an asset for the company. So, if so, whether the inventory of empty bottles existing on the date of balance sheet is to be considered as inventory of the company and valued as per AS2 or to be treated as scrap and shown as realizable value, corresponding credit to other income. Now friends, what is inventory? You have learnt in AS2, inventories are assets held for sale in ordinary course of business, assets in the process of production, and raw materials and supplies to be used in production or for rendering services. Now what is an asset? That is given under framework of preparation of financial statements. It says asset is a resource controlled by an entity from wherein future economic benefits will inflow to the entity. Don't you think this is an asset? Therefore, empty bottle is an asset for the company because it's a resource controlled by us only. Once the customer leaves the shop, you can say, after 2 days, my bottle is left out, give me my bottle. No, it's over. And this resource is an asset for us. And these assets are held for sale in ordinary course. Yes, sir. It is happening every time. Customer drinks milk, goes away. Then I call for tender. So I'm doing it on everyday basis, operating activities only. So this asset that is nothing but empty bottles will be treated as asset held for sale in ordinary course, and it will be inventory. Considering it as other income or scrap is not a correct option. Here the question says selling empty bottle, it means further benefits are accrued on sale, therefore empty bottles are asset for the company. As per AS2, inventories are asset held for sale in ordinary course of business. Inventories are empty bottle and have detailed control recording and accounting procedure which duly signifies it is materiality. Thus, inventory of empty bottles cannot be considered as scrap and should be valued as inventory in accordance with AS2. Question number 17. A Limited is installing a new plant at its production facilities and incur this cost. Now this PP sum. Cost of plant 25 lakhs. Yes sir, this will be forming part of my cost. Initial delivery and handling cost. Yes sir, this will also form part of my cost. Cost of site preparation. Yes sir, this will also form part of cost. Consultant used for advice on acquisition of plant. Yes, it will also be there. Interest charges paid to supplier of plant for deferred credit. No sir, this cost cannot be included because the asset is not a qualifying asset. Only if this asset would have been, PP would have been qualifying asset, I would have capitalized the interest charges. That is nothing but borrowing cost would have been capitalized. Estimated dismantling cost. Yes sir, this will be included. Operating losses before commercial production. Sir, these are not an expenses which are necessary to bring the PP in working condition. So this should not be included. So 25 plus 2 plus 6 lakhs plus 7 lakhs plus 3 lakhs. So 43 lakh is the value at which property plant equipment will be measured in our financial statements. Let us now move on to question number 18. Explain monetary items. How are foreign currency monetary item to be recognized at each balance sheet date? Classify the following as monetary and non-monetary. Now friends, what is monetary item? We have learned monetary items are items of cash, assets to be received and liabilities to be settled in fixed and determinable amounts. This is monetary. What is non-monetary? Other than monetary, everything is non-monetary. How are foreign currency monetary items recognized in the balance sheet date? Can I say on balance sheet date, all monetary items are carried at its closing exchange rate? Classified. Share capital, non-monetary. Trade receivable, monetary. Investments, non-monetary, and fixed asset is also non-monetary. Monetary items are monies held, assets and liabilities to be received or paid in fixed or determinable amounts of money. Foreign currency monetary item should be reported using closing rate at the balance sheet. However, in certain circumstances, the closing rate may not reflect reasonable accuracy the amount in reporting currency that is likely to be realized from or required to be disbursed. A foreign currency monetary item at the balance sheet date. In such circumstance, relevant monetary item should be reported in reporting currency at the amount which is likely to be realized from or required to be disbursed such item at balance sheet. Classification: share capital non-monetary, trade receivable monetary, investments non-monetary, fixed asset that is PPE also non-monetary. Now friends, coming on to question number 19, which is pertaining to government grants. S Limited has received a grant of 18 crores from government for setting up a factory in a backward area. Out of this grant, the company distributed 12 crore as dividend. Also, S Limited received land free of cost from state government, but it is not recorded in the books and no money has been spent. In light of AS12, whether the treatment of both the grant is correct? Obviously no. First of all, you have received 18 crore from government to set up a factory in backward area. Don't you think this grant is in the nature of promoter's contribution to be credited to capital reserve? This capital reserve is in the nature of capital receipt and is not to be distributed as dividend. This 18 crore cannot be utilized as dividend. So giving dividend of 12 crore is obviously inappropriate. You have received land free of cost from the government. If you receive any type of non-monetary grant, AS 12 says the grant received or the asset has to be recognized at its nominal value. That nominal value may be rupees 1 or 500 or even the cost of the asset. So in this case, we can opine that only. The grant setting off factor is not available for distribution of dividend. Even the asset acquired free of cost, it is to be recorded at nominal value. The treatment for both the element is incorrect. Now friends, the last question. Borrowing cost. This is with respect to para 4E of AS 16. Raj and company has taken a loan of 20,000 in the beginning of financial year for a specific project at an interest rate of 6%. On the date of taking the loan, the exchange rate is 48. The exchange rate at the closing of the financial year is 50. The corresponding amount that could have been borrowed by the company in Indian rupee equivalent is 11% per annum. Determine borrowing cost. Now see, first of all, what is the interest paid foreign currency loan? That is my borrowing cost. Can I say the interest paid will be $20,000 into 6% at 50? This is the borrowing cost. Which is 60,000. Now, this is interest paid on foreign currency loan. 60,000 is my borrowing cost. Now, to the extent of exchange fluctuations is also regarded as borrowing cost. So, exchange fluctuations to the extent regarded as borrowing cost. And that will give me total borrowing cost. Now, what is your exchange fluctuation, friends? If you look properly, your $20,000 was at 48, now it is 50. So my exchange fluctuation is 40,000. The initial recognition rate is 48. The subsequent recognition rate is 50. So exchange fluctuation is 40,000. Now, to the extent of interest rate difference and others. What is because of interest rate difference? Now, had you borrowed the loan in our country, Bharat, you would have paid interest at 11%. So that would be interest if borrowed in India. You have taken a loan of $20,000. You would have borrowed 48 rupees, so 9,60,000, on which you have paid 11% as interest. So you would have ended up paying 1,05,600 as interest. Less interest on foreign currency loan. How much interest did you pay on foreign currency loan? 60,000. So 45,600 is interest rate difference. It means nothing will be classified, nothing will be there as foreign exchange fluctuation, nothing. The whole amount of 40,000 interest rate difference will be classified as borrowing cost only, because this is Interest rate difference is only 45,600. So to the extent of interest rate difference, we classify it as borrowing cost. So here, the whole 40,000 will be here. So it will be 1 lakh will be my total borrowing cost. The entire exchange difference of 40,000 will be considered as borrowing cost. The total borrowing cost is 1 lakh. Now this 1 lakh will be nothing but capitalized provided the loan has been considered for a qualifying asset. But if the foreign currency loan is not considered for a qualifying asset, then this 1 lakh will be expensed off as borrowing cost. So here the whole exchange fluctuation will be considered as borrowing cost, because to the extent of interest rate difference, say for example this would have been 50,000, this instead of 40,000 this would have been 50,000, then friends I would have considered interest rate difference of 45,600 and remaining amount would have been considered as foreign exchange fluctuations. Okay, but here what is happening, the interest rate difference is more than the exchange fluctuation. It means the whole exchange fluctuation is my borrowing cost. Yeah, you may just have the stuff here. This is nothing but the concept of para 4E of AS 16, para 4E. Okay friends, so this is the end of your RTP revision for group 1. Thank you very much and all the very best for your exams.